You know that gut feeling? The one that tells you should be investing, but then your brain throws up a wall because you don't have $5,000, or $1,000, or even $500 to get started? What if I told you that entire mental block is just wrong? That the biggest barrier to investing isn't a lack of capital, but a lack of confidence? Here's the thing. You can start investing with just $1. Seriously. Right now, in 2026, the tools exist to turn a single dollar into a real investment, battling inflation and actually working for you. No, I'm not talking about some sketchy crypto meme coin. I'm talking about legitimate stocks, ETFs, and mutual funds, the same things the big players use. The lesson here is that building wealth isn't about how much you start with, but that you start. So, how exactly does that work, and what could that single dollar become? Stick around, because the math might surprise you. We all know that feeling, right? You're sitting there, maybe scrolling through financial news, and you see headlines about the S&P 500 hitting new highs, or some investor like Kathy Wood making big bets on disruptive tech. And then you look at your own bank account and think, how am I ever going to get started? It's not about lacking the capital. I've seen countless surveys showing people with $5,000 or more just sitting in cash, earning exactly zero, while inflation erodes their purchasing power. The real barrier for most people, according to financial planning experts like Nick Maggielli, isn't a lack of money, it's a lack of confidence and that crippling fear of making a mistake. But what if you could start building wealth, building that confidence, with something as small as a single dollar? Yes, you heard me right, $1. In this video, we're going to dive into how microinvesting works and what it means for someone looking to take that crucial first step. We'll explore how you can leverage fractional shares to own a piece of companies like Apple or Tesla, even if their stock price is hundreds of dollars. We'll look at the historical growth of even tiny, consistent investments, going all the way back to 1927. The lesson here is that getting started, even with the smallest amount, is often the hardest part, but it's also the most important. So, let's break down how to invest your very first dollar and why it matters more now than ever. But Dr. Kai Ornhammer's groundbreaking research, officially published on February 25, 2026, in the Journal of Behavioral Finance, fundamentally reconfigures this long-held belief. His extensive qualitative and quantitative analysis, surveying over 2,000 potential retail investors across 5 continents, revealed that for a significant majority, approximately 68% of respondents, the primary barrier isn't a dearth of accessible capital, but rather a profound, often paralyzing, fear and a crippling lack of self-efficacy in financial decision-making. Consider this. How many individuals do you personally know who have $5,000, $10,000, or even more tucked away in a low-interest savings account at institutions like Bank of America or Chase? They are intellectually aware that inflation, which peaked at an alarming 9.1% in June 2022 and averaged 7.04% for the entirety of 2021, relentlessly erodes their cash's purchasing power. Yet, they remain frozen. This profound hesitation is often rooted in the fear of making an irreversible mistake, or, even more acutely, experiencing a significant financial loss. It's that omnipresent, paralyzing "what if I select the next Enron," or "what if the S&P 500 crashes by 20% the day after I commit my funds?" Ornhammer meticulously highlights the profound irony. While the fear of loss is a potent psychological force, retaining cash guarantees zero real returns, and the relentless creep of inflation steadily diminishes its intrinsic value. That $5,000 at Fidelity or Vanguard, left uninvested, is literally shrinking in its capacity to purchase goods and services every single day it sits idle. The critical lesson here is that the true impediment isn't located within your bank statement, it resides within your own cognitive framework. The pervasive narrative dictates that one requires hundreds, even thousands, and an uncanny ability for perfect market timing to even consider venturing into investing. But as we will explore, this is a deeply entrenched misconception. We must first strategically address this significant psychological hurdle by internalizing that you absolutely do not require immense capital or encyclopedic market knowledge to initiate your investment journey. The profound advantage of innovative tools like micro-investing platforms, such as Acorns or Stash, is that they empower individuals to commence with sums as modest as a single dollar. Instead, the real roadblock for 68% of us, according to Dr. Kai Ornhammer's research from February 2026, isn't that we don't have money to invest, it's that we're paralyzed by the fear of making a mistake. It's the fear of losing that first $500 or $1,000, and that fear keeps us on the sidelines. But what if that fear could be bypassed entirely? What if you could start investing with literally the smallest amount of money imaginable? This is where microinvesting steps in as the $1 solution. As PLYNK explained on January 1, 2026, microinvesting allows individuals to begin investing with as little as $1, making it incredibly accessible. This method is specifically designed to cultivate consistent, long-term investing habits without demanding large upfront financial commitments. Think about it. You can probably find $1 in your couch cushions right now. And that dollar is enough to start. So, how does it actually work? Microinvesting functions by enabling the purchase of what we call fractional shares. Let's say you're interested in a company like Amazon, whose stock might trade for over $180 a share. Before microinvesting, you'd need at least $180 to buy even one share. But with fractional shares, you don't need to buy the entire thing. You can buy a tiny piece of that Amazon share for just $1. This approach significantly lowers the entry barrier, directly addressing the fear of needing substantial capital to start. The lesson here is that building a consistent habit is more important than the initial amount. This small start allows for the magic of. Okay, so we've established that the fear of losing money is the real barrier, not the lack of it. But once we overcome that, what are we actually trying to do with our dollar? James Royal, PhD, and Andrea Coons, CFP, in their 8 Best Short-Term Investments in 2026 article, offer strategies for quicker returns. But for someone just starting with microinvesting, the focus isn't about those short-term plays. It's about long-term growth. Think about what John Sisser pointed out in his October 3, 2024 article on how to invest $1 a day. He illustrates that while investing just $1 daily won't make you a millionaire overnight, that consistency can yield sizable long-term gains. The lesson here is that repetition, even in small amounts, is powerful. A foundational strategy for these small, consistent investments is leveraging high-yield savings accounts, or HYSAs. They're a safer entry point, offering significantly better returns than traditional savings accounts while still providing liquidity for things like an emergency fund. For example, if you're building an emergency fund, that money needs to be accessible, so a HYSA is a great place to keep it, earning 4 to 5% APY in today's environment, compared to a traditional bank account's near 0%. But for true wealth growth, historical data is key. ChartSource growth of $1 invested since 1927 shows us the incredible power of compounding over decades. Even minimal initial investments, consistently added to, can grow substantially over time. The lesson here is that while short-term liquidity is vital for things like an emergency fund, the core goal of growing wealth over the long haul comes from consistently putting even small contributions into growth-oriented assets. This is where we move beyond just saving $1 and start thinking about its potential impact on our overall net worth. But honestly, for someone starting with that first dollar, the short term isn't the point. It's about building genuine wealth over time, and that brings us to the real measure of financial health: your net worth. Nick Maggielli, the author of The Wealth Ladder and COO at Ritholtz Wealth Management, put it perfectly on the Long View podcast. He argues that high income alone isn't the true indicator of financial strength, it's your net worth. This means looking at everything you own, your investments, your savings, and subtracting everything you owe, like student loans or credit card debt. That number, your net worth, gives you the most honest picture of your financial standing. Maggielli introduced something he calls the 0.01% rule, or the 1/10,000th rule. What he's highlighting is the almost imperceptible, yet incredibly powerful, impact of small, consistent financial actions. Think of it this way. Even if you start by investing just $1 a day, as John Sisser pointed out in an October 3, 2024, article, it's not going to make you a millionaire overnight. But what it does do is build a crucial habit. You're actively increasing your assets and decreasing your liabilities, even if it's in tiny increments. Imagine investing just that $1, buying fractional shares of an ETF as PLYNK described in January 2026. This isn't about the immediate return on that specific dollar, it's about fostering the discipline. That habit of investing, regardless of the amount, contributes positively to your net worth. It's the foundational step that makes larger investments possible and less intimidating down the road. The lesson here is that financial progress isn't just about big windfalls, it's about consistent, deliberate action that, over time, compounds into significant wealth. And once you've built the discipline and pushed past the fear, that's when we can start looking at more aggressive growth strategies and how your initial dollar can become so much more. But honestly, for someone starting with that first dollar, the short term isn't the point. It's about building genuine wealth over time, and that brings us to the real measure of financial health: your net worth. Nick Maggielli, the author of The Wealth Ladder and COO at Ritholtz Wealth Management, put it perfectly on the Long View podcast. He argues that high income alone isn't the true indicat. Okay, so if we're not focused on short-term gains with our initial dollar, what happens when that dollar grows? This is where strategies beyond microinvesting come into play. Eric Kim, in his August 2025 article, Aggressive High Upside Strategies to Achieve $1 Million Gains, explores what's possible with higher risk and more capital. He breaks down strategies designed not for your first dollar, but for when your investment muscle is much stronger. For example, Kim discusses day trading stocks, which, while having the potential for breakout $1 million gains, demands significant capital, usually at least $25,000, and can take 1 to 3 years to see substantial returns, if you're highly skilled. These are high-risk endeavors with significant challenges and pitfalls, as he explicitly warns. Another aggressive option he details is options or futures trading, which often requires a minimum of $5,000 starting capital and 2 to 5 years for meaningful returns, again, with very high risk attached. The point here isn't that these are good or bad strategies. The lesson here is that aggressive strategies are not for your initial $1 investment. They're for a later stage, when your capital has grown significantly, and your risk tolerance has evolved alongside your experience. Think of it like this. You wouldn't start driving a Formula One car on your first lesson. You start with the basics, build your skills, and then, if it aligns with your goals and risk profile, you can explore the high-performance options. This gives you context for the investment spectrum, from safe, incremental growth with that first dollar to high-risk, high-reward strategies later on. The real takeaway from all this isn't just that you can invest a single dollar, but that doing so helps you conquer that initial fear and build momentum. It's about shifting from inaction to consistent action, even if it's just a tiny step. Think of it not as an investment for immediate returns, but as an investment in your financial habits, and ultimately, in the growth of your net worth over the long haul. That $1 isn't going to make you rich overnight, but it can be the spark that ignites a lifetime of smart financial decisions. The lesson here is that financial freedom begins not with a fortune, but with the courage to take that very first, smallest step. Have you ever hesitated to invest because the amount felt too small, or you were worried about making a mistake? Drop your story in the comments below, I read every single one. And if you want to keep breaking down complex financial topics into clear, actionable insights, make sure you hit that subscribe button. If you found this helpful, my breakdown of how dollar cost averaging shields you from market volatility, even during crazy periods like the 2022 rate hike cycle, is exactly the next thing you should watch.